Hello, everyone. Good afternoon, and welcome to today's Sherpa Funds Technology Process Alpha webinar. Today, we're going to be talking about how center book strategies can maximize internal alpha capture. My name is Stephen Quimby. I'm in charge of sales and marketing here at Sherpa. I'm joined by our founder and CEO, Richard Waddington. Richard, do you want to give everybody a hello?
Hello, good afternoon, everyone, or good morning, wherever you may be. But thanks so much for joining
Yes,
us.
today we have no North Americans because we've booked a time that no one in the US can possibly make, but we should have a number of people joining us from Asia and from Europe. So if you're here in Asia with us, good afternoon. If you're in Europe, good morning. So for those of you who are joining us for your first Sherpa Funds Technology webinar, few general sort of lay of the land things. We will be trying to fit our topic today into around half an hour. We have a lot to cover today, so I wouldn't be surprised if we go just a little bit over. And then we will stay and handle any and all questions at the end. If you do have any questions that you want to ask midway through, feel free to put them in the chat panel on the side of the platform here, and we'll try to get to them as we can. If it's particularly relevant, maybe we'll jump on it right then. If not, we'll certainly do it at the end. Also, if you have to jump off midway through, we will have the webinar replay online on our Sherpa Funds Tech YouTube channel. If not yet today, certainly by tomorrow, and we'll send out the link to that. So if you have to run for whatever reason, market gets away from you, by all means, the webinar will be there tomorrow for you to check out. So with all that said, let's get started on our topic today. So today we're going to be talking about center book strategies, which is something that we thought would be interesting to chat about because this is something that we work on here at Sherpa. And we know quite a few, large sophisticated hedge funds work with, but in practice, it's not something that we see implemented as widely as we think could be. There's a lot of different multi-manager organizations, a lot of organizations that have information that goes underutilized because they don't feel comfortable or have the resources in-house or kind of think through the process of implementing a center book in their own process. So what we're going to do today, we'll have a short introduction, what center books are all about, some of the key considerations to think of as you think about whether or not a center book might be a fit for your organization. And then we're going to walk through two examples that we've done with live Sherpa client data. So the first example is a global equity long only multi-manager. The second example is an Asian equity long short. So it's going to be two different styles of center book, but talking about the same concept and showing how the ideas actually work in practice. And then finally, as I said, we'll do questions as we have time at the end. So to start us off, multi-manager, multi-analyst organizations generate a lot of information. So you have many different PMs. Each PM has their own different team of analysts. You have risk teams, you have quant teams, you have the CIO, you have all sorts of different people generating valuable, potentially alpha having information in the organization. Now, in practice, what that means is that most of that information is applied at the portfolio level for an individual strategy, an individual pod, an individual fund manager. And then the combination of those into a master fund, into a pension trust fund, is done simply by putting a lot of strategies together, hoping that they're relatively uncorrelated, and hoping that the sum of all of these parts from a risk and return perspective is as good as or better than the individual strategies on their own. Now, obviously, this is something that a lot of hedge funds, your Point 72s of the world, Citadels, and really any of your big multi-manager funds, they address some of the shortcomings of having all of this information at an organizational level, but only applied at the portfolio level by running a center book strategy. So the center book is something that's typically operated by the senior management. This could be the chief risk officer, it could be the CIO, it could be the head of equities, depends on the structure of the firm. And the idea is that the center book sits on top of the other individual books, of the other individual portfolios and strategies. And it's traditionally, when people talk about center books, the idea is that it's kind of a best ideas book, that it provides more exposure to the fund's best ideas. Now, these strategies tend to be relatively complicated in terms of how you run them, in terms of how the data works, because you have to get the data from all of your individual strategies. You want to run the center book with regard to or sort of aware of what the other strategies are doing. And so there's a lot of data and coordination, which means that historically this has been something that you really only see at very large and very sophisticated funds. Now, fundamentally, we don't think that that necessarily needs to be the case. So if you're a smaller fund, or if you're a multi-manager long only, if you're a pension fund, if you're a real asset investor that gets position level data from your external managers, in all of these cases, you have the information already within your organization, and you probably increasingly have the technology to organize it to run a center book strategy. Now, this is something that takes the information that you already have and applies it at a portfolio level on top of all of these other strategies to better realize the alpha, to better capture the value within that information without actually interfering with the underlying managers. And I think that's an important point. That's something that we've found as we've worked with people on this strategy. They don't really want to interfere with what their PMs are doing. They don't really want to interfere with what their analysts are doing, but they know there are shortcomings in how the information is being applied that the center book could potentially help with. So the center books, as a tool, it has a wide range of possible applications. And we're going to talk about some of the considerations and some of the different types of center book that you could run. So a few considerations here. So number one, and this is a really common one, are the PMs taking enough risk in their best ideas? I mean, the famous Millennium model, right? You get a tap on the shoulder if you're down 5%. That might deter your PMs from taking as much risk as they should or as they could in their best ideas. At a business level, does our full combined portfolio really reflect our house views? Does it reflect our PMs and analysts' views? If we have a lot of different PMs and analysts who like the same stock, if as a business we really, really like Alibaba, are we backing Alibaba as much as we should to reflect that view? Do we have excess capital that we could be deploying against our ideas? Are we getting the most capital deployment against the alpha that we have? Does the organizational portfolio, as the sum of all these individual PMs, does it reflect the views of the CIO, the CRO, of different parts of the investment organization? In practice, I talk to a lot of places where the quant team and the CRO is trying to do remedial work with each individual PM to try to sell them on the idea of doing what the organization wants them to do. The center book can be a remedy for that. Do overlapping positions produce unintended risks? So if you have two strategies that you think are uncorrelated, but in practice they're more correlated than you think, the center book is something that you can use to help manage that risk. And really, if we take everything together, do we take the desired sets of risks? Do we have the risk we want to take in the portfolio? And there's kind of one more particular tricky question, and we're moving pretty quickly through this. Again, try to keep on it in half an hour. So if you want to go into this in more detail and some of these questions, some of the considerations, by all means, reach out to me on email. But one other tricky question to think about is who's going to own a center book? So within the organization, if you're going to implement this, who owns the P&L? Who's responsible for the project? If it works or doesn't work, who's going to wear that? And this is something, typically it's a CIO project, it's a CRO, it's a head of quantitative strategies, something along those lines. But this is one of the many kind of questions and hurdles you have to think of when thinking about how you would design a center book for your organization. So we're going to talk today about different types or sort of different objectives, if you will, in terms of building a center book. So there's a lot of different things you could do, a lot of different possible objectives, but for simplicity's sake, we're going to reduce down to kind of three core concepts. And so the first is what we call a conviction maximizer. The second is what we call a liquidity user. And the third is what we're going to call a risk overlay. And so these aren't mutually exclusive concepts. You can think of these as sort of levers or sliders, if you will, how much you want in conviction or how much you want in terms of maximizing liquidity or in terms of mitigating overall risk. But these are three kind of the core objectives you have to be thinking about when you think about a center book strategy. So the conviction maximizer, this is about topping up underexpressed ideas. This is about saying, we don't think our PMs are taking advantage of or fully able to express the ideas that they have to capture all the alpha in their ideas. This could be because the PM is risk averse. It's because the PM has individual strategy risk limits. It could be because of constraints that are put on the portfolio, regulatory constraints in terms of how the portfolio is built, in terms of what the risk team puts on. There's a lot of different things that could go into restraining PMs from being able to take advantage of their convictions. And so the idea behind a conviction maximizing book is that management can top up the best ideas, that management can take those convictions that are being underutilized or underexpressed and sort of fully lean into them where appropriate at an organizational level. So the second idea, and this is a little bit related, but the idea is a liquidity using book is about using all of the liquidity in the market that there is within your ideas. So getting as much usage of the market for your alpha as possible. So again, there's all sorts of reasons that individual PMs might be limited in terms of position size limits, in terms of limits on the liquidity because of the frequency with which they have to trade, places where they're already uncomfortable with the size of where they are in the holding table, any number of these things. But at an organizational level, you have a full view of how well the organization can use liquidity, and maybe it's not going to be in smaller cap stocks, but in a lot of those large cap stocks or in a lot of maybe non-equity instruments, there might be a lot of liquidity left on the table that you're not presently using. And finally, the third option that we're going to talk about, a risk overlay. And we're not going to do an example of a risk overlay today, but kind of fits in a little bit with the other things we're going to talk about. But the idea here is that the risk overlay sits on top of the other portfolios to manage the risk exposures that you have as a firm, as a business, as an organization. And so that's to say, if you want to mitigate particular style factors or macro factors, if, for instance, you've told your investors that you're targeting a particular level of specific or idiosyncratic risk, a risk overlay is a way to manage that. If you've told your investors, or if most of your investors are consultant driven, where, for instance, that risk mitigation is a big part of their checklist for evaluating funds, the risk overlay is a way to deliver the risk exposures that you want the master fund, the master vehicle to deliver, even without interfering with, again, the individual strategies in terms of how they run their risk. So we're going to walk through two examples, as I said, in practice today. This is something that we've done with a number of different firms, something we've done with a number of shops. The idea here is that first you have to design the center book. And once you've designed a center book, you can either run it in a discretionary manner, or at Sherpa, we would suggest that this is something that's usually best run in a systematic manner. And so these are two examples where we've designed center book strategies with the client and where we've put it into practice using systematic portfolio construction techniques to extract more value from the alpha. So as I said, the first example, it's a large, long-only, multi-manager, sort of global equity organization. This is more of a liquidity using center book. And the second example, for an Asian equity long-short hedge fund, this is going to be more of a conviction maximizing center book. So Richard, would you like to walk us through what we're looking at for example number one?
Yeah, sure. Thanks very much, Stephen. So this is a client of ours that runs a very large portfolio with multi-managers. And this is one subsection of their business, which is running kind of roughly around about 25 billion through 5 different PMs. Across those 5 PMs, they will have at any point in time somewhere between 200 and 250 stocks. So, averaging about $100 million position per stock. So these are serious, large institutional long-only clients. The business is run with the PMs in their individual silos running those portfolios, and there's very little kind of cross information flow between them, and the individual portfolios do their own little thing. Now, you move on. There we are. What is there in this organization beyond just the portfolios, right? What sort of information is there? And I think this is reasonably typical of any of these large multi-manager type portfolios. But what do we have? We have PMs who work with their analyst groups to generate stock selection. So list of assets and convictions on each stock. And then we have a whole bunch of data that we, Sherpa, and the business itself has put together and show, okay, well, where does this information work? Where is the real value? So there's consistent positive alpha in their highest conviction and their stocks, which are the largest, most liquid stocks, and consistent negative alpha. I mean, that sounds a bit bad, but they aren't so good at the small stock picking. I think, there's perhaps a feeling, oh, I should try this one because it might go 10 times, but of course it doesn't. The other thing we see is that there's a consistent positive bias towards growth style factor, which of course in the last year or so hasn't been very helpful for them. And there's some other factor risk, which actually we're not really going to talk about here so much, but they are there. And then the final far part is that the trading teams say, actually, we can trade, within the liquidity constraints that we want to operate within. There is excess liquidity in many of the positions that we hold, some of which we have very high convictions in, and we're not using that liquidity. We're not expressing our view, taking advantage of that liquidity. And on top of that, there is excess capital to deploy. So when you bring all that together, you say, okay, let's see what we can do with it. Now, this first graph shows how they have done. The purple line, which is the top line, is the benchmark that they follow. And the aggregated 25 billion that is being run against this benchmark on aggregate is trailing that benchmark. And it's trailing it because, as we said, they are long growth, and it hasn't been a great 10 months worth of data. Hasn't been a great 9 or 10 months for growth. And there's been a drag from those selection of the smaller stocks. Okay, but so that's the picture, right? The 250 odd stocks they're holding, and that's how it's done. Now, if we take those 250 stocks and we say, okay, what can we do with it and apply it to another, say, we've used a $4 billion excess pool of capital on here. How can we generate a book that takes advantage of the excess information with those objectives that we just went through? So we want to use all the convictions, so use the best ideas, the ones that we know historically work. And we do that by, of course, looking at what the convictions are, removing the stuff that's a low conviction, and saying, okay, now we've got, at any point in time, something like 100 stocks across these 5 PMs. So that, this kind of makes sense, right? Each PM has got 15 to 20 ideas they really like. So we've got 100 stocks across these 5 PMs that we want to put money into. Now we want to also look at, well, okay, where is the liquidity in those 100 stocks? And if some of them are, there's no excess liquidity relative to some liquidity limits, and the liquidity limits we set with this business is, I think we said 5% of free float market cap, or a third of one day's trading volume. And I remember these are big long only investors, right? They don't have to get in and out quickly, but they want to make sure they're not totally swamped by the market. So the first thing you can do with just that basic set of information is, okay, we've got 100 stocks and we've got a liquidity max for each stock. Okay, what would happen if we proportionally allocate those 100 stocks relative to their liquidity? And if we do that, we end up with, you can see the green line on this chart. So we've materially improved the return of the PM silos themselves. And we've done it by taking the best ideas and using it within the liquidity of the market. So we haven't done anything that's difficult or hard, or impossible to do. But we've applied their own information in a relatively systematic manner. But this is not, doing this is very naive in a risk sense. Of course, Sherpa, we are a risk-focused organization. So if we add some risk sophistication to this, we go from what was the green line. So remember, the purple line is the benchmark. The reddish line at the bottom is what they actually did. The green line is the naive center book, so unsophisticated. There's some background noise that was going. And then the blue line at the top is what happens if we take that same set of 100 stock selections at every point in time and create a sophisticated portfolio from it. Now, there's no new work having to be done by the organization to achieve this blue line. The work has already been done. The work is there in the selection of the assets and the scoring and the liquidity. Sorry, let me just see if we can. Somebody's got a speaker on the. I know it's not. Yeah, okay. Weird. There's no new work from the organization. The organization put the work in to get the asset selections, the scores, to get the liquidity understanding, to understand what it is they want to do. But the improvement in performance is really quite dramatic. And this is, and again, it's not saying you can do this with the full 25 billion, but it's saying you can take a 4 billion center book as a liquidity mop, a liquidity sponge, use the liquidity that's available in the market to express your ideas better. And you can see, I mean, the graph kind of showed it all, but you can see dramatic difference in returns, both relative and absolute, in drawdown and volatility. We know that the original PMs lag their benchmark because of their growth bias and because of the small stocks they have. We've used a proper systematic portfolio construction on a smaller pool of capital, so less than 20% of what they've got, so 18% of what they've got, to create a center book which uses up that excess liquidity in the market, applies their best ideas to that excess liquidity, and generates a much better set of returns. Now, one of the things you can ask is, well, where does this improvement really come from? And so if you plot those same graphs, this is just what they did, what a naive center book does and what a sophisticated center book would do in relative space, so benchmark relative. You can see there's a very big difference, right? And it's consistently growing over time. Where are these differences happening? Well, if you look at let's call it the basic or the naive center book against what they actually had, you can see the naive center book, when each dot represents a weekly return, a weekly period, and the naive center book is on the y-axis and the basic and the main book is on the x-axis. And you can see that when the real big difference is that when the main book loses money, so we're in the bottom left quadrant, the naive center book loses less, so we're above the y equals x line. The naive center book is much lower vol on the downside. However, it also is clearly a bit lower vol on the upside. You can see that we are losing potential upside by creating this naive center book. So that's partly where when we say, okay, let's do a more sophisticated approach, rather than these 105 stocks that are spread out over everything, let's use the Sherpa technology to create portfolios that end up somewhere between 25 and 35 stocks at any point in time. So, all consistent, all liquidity constrained as normal. You get a much better, this is the blue line, you get a much, much better return. And you can see where the Sherpa tech approach outperforms the naive, the basic center book, well, pretty much across the line. Certainly when we're losing money, we lose much less. We always expect that with Sherpa portfolios because we focus so much on minimizing downside vol. Then also relative to the naive center book, we no longer are deficient when we're making money. We actually make more than the basic book. So the overall takeaway from this is that by taking this huge amount of information that exists in this very big firm, we can apply it to a center book, small extra pool of capital that performs extremely well, that requires no extra work at their end, and uses all their own business objectives and constraints. So this is what I'd call a really classical example of using the liquidity, right? A liquidity maximizer, we didn't use that word, a liquidity sponge to express your views better, given the liquidity in the market.
And this, the same concept. So as we talk about our second example, right? It's the same core idea. The organization has this information, right? And the things that we want to take advantage of there, the asset selection information, the views we might have about which types of asset selections are better than the others, or if we don't have any views on that, things we might want to control for in terms of factors, liquidity constraints, whether you're long, short, long only, whether you're pure equity, whether you're multi-asset, however, you have this information already within the organization. And it's just a question of marshaling the organization and designing a strategy that meets your objectives for that set of information. And so the second example we have here is a long short fund. And so this is Asian equities, long short, much different client. So much higher turnover, much more tactical in nature, much smaller, much more sort of agile, if you will. And so here in this example, we have two different portfolios with very different styles. They own about 200 stocks over the course of the period on more than 200 million in assets. And at any given time, they have, let's call it 100 to 120 stocks between the two portfolios. Now, the two PMs here run very different strategies. And this is what, when we talk about people combining different strategies that, you hope are uncorrelated, you hope they're fairly different, you hope that you're going to get a whole that is better than the sum of the parts. The first strategy here is very directional. It's very high net. It's very high vol. It's very high risk. It runs a pretty significant beta versus the market. The second strategy is market neutral. It's much lower turnover. It's much lower vol. It's basically no beta. Again, market neutral. It's run very conservatively. Now, the trick here is that this is not a big fund, and so they don't have a huge number of centralized resources to think about how they run a center book, which is why they started working with us on this project. And if you combine these two books simply, right? If you just say, I'm going to split my capital 50-50 between these two strategies, you end up with a fund where the risk and return is overwhelmingly going to be driven by strategy number one, because strategy number one has much higher risk, it takes much bigger directional positions. And so you're going to end up with something that looks more like number one than number two. So this is problem number one. Now, the real question that the CIO had was, fundamentally, I think that PM number two is so low vol because they're just not backing their ideas enough. PM number two is not a particularly risk-seeking PM. They're really good as an analyst. We have great confidence in their abilities to pick the right stocks, but at a portfolio management level, they just don't take any risk. And so what the PM wanted to do was to look at an overlay, a conviction maximizer that would maximize the exposure to the alpha that PM2 is generating without increasing the downside risk, without increasing downside vol concentration at the aggregate master fund level. And so this is a conviction maximizer that's expressing more of PM2's asset selection alpha in a way that is aware of and positioned in regards to PM1's much higher volatility strategy so that the overall fund risk is controlled. So we went through this process, and what we were doing, we decided that we would gross this PM up from, let's call it 100%, 125% gross, up to 175, 200, or 225, so that the CIO could decide how much risk they wanted to put on at a given time, how much gross exposure they wanted to have to PM number two's ideas. Now, obviously increasing the gross from 110 to 225, doubling the gross, comes with an increase in risk. Most risk sophisticated portfolio construction in the world is not going to get around that problem. But the real question is, can you do that in such a way that at the master fund level, the risk balances out? And in fact, yes, you can. If you take a systematic approach, a risk-focused approach to portfolio construction, you can gross up a strategy that is lower risk in a way that counterbalances the strategy that is higher risk and produces an overall risk level that is fairly controlled, fairly consistent with what you want. So what did this drive? So we started this project in 2021 with this firm. And in the latter part of 2021, it added 300 basis points in return on actually lower volatility. So in spite of the fact that the leverage used had increased substantially to back these PM's convictions much more aggressively, risk was well controlled, volatility was lower, drawdowns were lower, and they got substantially more return as a result. And like we talked about at the beginning, and this actually wasn't really the objective of this exercise. For this particular PM, they just really wanted to keep vol in check. That was really the only risk characteristic they cared about. But as an outcome of the process, doing this in a way where they took more risk in PM2's ideas, they were able to substantially increase their specific risk. So they went from a specific risk of, call it 50% in the original fund to a specific risk of close to 75% in the combined systematic center book fund. And so this gives not only more returns and greater risk, but if they wanted to talk to more consultant-driven, more idiosyncratic or specific risk-driven investors, this is a much more investable risk profile because it's much more pure selection alpha. When we moved into 2022, we've been able to see the same dynamic. So again, as we look at the realized examples within this much higher vol period, a much more challenging period in the market for this strategy than 2021, the first strategies posted, again, very high vol. It's had significant drawdowns and it's had very significant beta to the market. The second strategy, on the other hand, has produced consistently positive returns with really minimal drawdown, very low vol, no market beta, but the end result is that all of the risk is in fund one or in portfolio one. And so the master fund has actually trailed the market just narrowly on, a not insignificant vol and drawdown number. And this is the sort of raw combination. Now, if we look at what we did in the systematic center book world, the systematic center book world, again, is able to control risk. So the vol is actually a little bit lower, again, on a realized basis. The drawdown's a little bit lower because, again, the process is very focused on controlling downside vol and controlling risk concentration. Beta against the market's lower. And by limiting those sharp drawdowns, returns are higher over the period. So they're getting much more out of their alpha in a much more risk-controlled package by using a center book strategy to better implement the information the organization has. And so, again, the core message here is that whether you're again, you could be a multi-manager organization, a traditional multi-strat hedge fund, you could be a multi-manager long only, you could be a fund of funds, you could be a pension, an asset owner that gets sort of position level transparency. Good center book strategies can add a lot of value. The information is something that the organization already has, and a simple combination of portfolios probably does not capture as much value from that information as you could by integrating a center book on top of it. And so whether your concerns are more focused on maximizing conviction, using liquidity in the market better, delivering a more investable risk profile, a center book strategy is a way that you can improve along those axes at an organizational level using the information you already have. And so, when we first started penciling out this idea, the core concept behind the webinar was, should you use a center book? Should your organization think about it? And the more we've explored data, the more we've talked to different managers, I think the more we think that most multi-manager organizations can benefit from a center book strategy, not just the really large funds. And frankly, if you look at the way your technology stack works today, the information is much more accessible than it probably was 5 or 10 years ago for you. And further, if you think about different portfolio construction techniques, the whole thing is probably a much more doable thing than you would have thought, again, just a few years ago. Different organizations have different priorities. And so it could be, again, for these purposes of this discussion, let's say conviction, liquidity, and risk. And then that systematic process is really a way that you can create a center book strategy that's designed to meet your particular objectives that maximizes the value from your information. We don't want to trivialize the fact that there are hurdles you might have to overcome to design one of these strategies and to implement it. In our experience, these are all things that you can get over. They're all things you can work through. They're all things that are a matter of discussion and of intelligent design in terms of how you think about your center book, rather than something that should be a showstopper that says, as an organization, we're not even going to explore this idea. So we're, like I say, we tried to make half an hour. We're a little bit long, but given how much we had to say, I think we did pretty good. If anyone has any questions, feel free again to put them in the chat. Feel free to reach out to anyone on the Sherpa team if you'd like to talk about this. Emails are right here, phone numbers are right here, LinkedIn, however you prefer to reach out to us. Richard, anything that we haven't covered that you want to make sure we said?
I think this whole concept is, it's a part of the bigger picture that we at Sherpa always talk about. You as a fund manager, your IP is your ideas, your asset selections, and your convictions. And behind that, there's all sorts of stuff. But the maximizing the value that you as a business extract from that IP can be done in lots of ways. It can be done within the portfolio. It can be done, the way you market, everything else. But this is particularly when you are a multi-manager, multi-analyst type organization, it is inevitable that you will be leaving something on the table, leaving something behind in the journey from idea to product. And this is one way to try and mop up that excess idea within the constraints of your business to generate more revenue for your clients, for yourselves.
Yeah, I think that's right. This is about getting a better usage of your information. This is about extracting more value from what you do, better realizing the alpha, if you will, in the business. So I don't see a lot of questions coming in, which is great. That either means everyone is entirely overwhelmed or that we have just done such a great job covering things that it's all very clear. So in any case, some people have joined us late. If you've joined us late, replay will be online on the YouTube channel, Sherpa Funds Tech Process Alpha YouTube channel. If you'd like to see the slides, feel free to reach out to me, Stephen Quimby at sherpafundstech.com via email, and I'm happy to share the slides. If you want to have a conversation, again, just reach out. And so everyone, I'd like to thank you so much for joining us today. Richard, thanks for taking the time and going through this with us. And so we'll be doing more Sherpa Funds Process Alpha portfolio construction webinars in the future. So we'll look forward to having you guys join us next time.
Great. Thanks very much, Stephen. Thank you all.